Looking at the scorecard into this Friday, the developed currencies are mostly down against the US dollar since the weekly open, with only the yen and Canadian dollar managing to hold up with the buck, trading flat since Monday. The pound has been hit the hardest, down around 1.5%, while the euro is just behind, down a little over 1%. What's interesting about this week is that there is another market away from FX that isn't used to sitting on the short end of the scale, and this market has performed even worse than the pound. The market is US equities, with the S&P 500 down just a little more than the pound, but also around the 1.5% mark. The takeaway here is that stocks which haven't been used to underperforming are starting to do so, and this is no coincidence with the relative weakness happening at a time when central bank policy normalizations are ramping up, and in a week where the Fed has pushed the process further along after officially signaling inflation was no longer below target. This means the odds for that fourth rate hike in 2018 are looking much more realistic, and if the case, will make equity market valuations less attractive. Of course, today we'll get more color on the Fed outlook front with the U.S. jobs report due. We've already covered the report in a special update and would recommend checking it out, but the main takeaway is to keep an eye on that hourly earnings component, which will give us another indication of just how much more hawkish the Fed will need to be. If hourly earnings come in above forecast, expect the dollar to extend its run and definitely expect stocks to come under more pressure. It has been the view of this desk that ramped up policy normalization will be a big part of the driver behind a 25% decline in the S&P 500 off its record peak from January, which would take us back to around the 2140 area, which coincides with the 2015 high. We believe this move is already underway and could easily play out by the end of 2018, if not much sooner. As far as the calendar for the rest of the day goes, services PMIs and retail sales out of Eurozone aren't going to really move markets. Canada IV PMIs are due, and there's a lot of central bank speak to monitor. We'll also get more headlines out from the US-China trade talk front. But ultimately, the volatility for the day is going to come from the U.S. jobs report. Earlier today, Aussie got some help from upward revisions to underlying inflation forecasts, and this was well reflected in the Aussie Kiwi rate, which we continue to see as undervalued and bottoming out on a longer-term basis. As far as the euro goes, while the single currency has taken quite a hit and put in a positive close against the buck on Thursday, technically it was an inside day, with the major pair confined to trading within Wednesday's range and more likely deferring to consolidation ahead of what could still be another drop. In our technical insights piece, we highlight the possibility for a deeper drop in the days ahead into the 117s before the euro then finally considers pushing back up again. That's all for now.